Well, good morning and welcome everybody. It looks as though we've gone live to YouTube, which is brilliant for everybody who's online with us today. All is good here in Cheltenham, Gloucestershire. It's a bit cold, a bit wet actually thoroughly wet. I don't care what people say, it's very, very, very wet out there. I'm up to Scotland this afternoon on the train. I'm certainly not going to be catching or driving, not in this weather, the wind and all sorts of things going on. It's terrible out there, isn't it? So let's get on with some of the topics that we've got planned for you today. I want to talk to you about a number of topics. I've got help to buy, I've got investment trusts, I've got Scots Law as well. We're talking about going to Scotland. So let's talk a little bit about Scots Law along the way. Yesterday we went into town. Shelley and I went into Cheltenham Sunday afternoon shopping. Sounds like a great day, doesn't it? But the fact is we had to get some new bits and pieces. And we're 5 minutes walking distance from town. So we went into town, went to John Lewis and all sorts of new retail environments. John Lewis is great. If anyone's ever been there, it's almost like an experience now. You know, you can experience things as opposed to having to just buy stuff. I loved it. You know, we were walking past a number of the banks and the building societies. They're all there, big stores, big open plan stores with lots of comfy chairs and little meeting sections and whatever, you know. They're all closed because it was Sunday afternoon. And I was thinking to myself, you know, that business model that they're operating now, banks and building societies, is exactly the same as I operated in 1982, which is, you know, 30 odd years ago, approaching 40 years ago. In a building society, admittedly, we didn't have the comfortable armchairs and the technology that they've got now, but we still sat down with customers and talked to them about mortgages and loans and stuff like that, you know, face-to-face talking, and we chatted to them. They still got the same business model, and I really do wonder whether they foresee it, or the people that make the decisions for them are so entrenched in the old way of doing things that they don't see another way. They'd rather get a nice, more comfortable armchair or a little private section where people could be interviewed. They're just tinkering with the same old business model, and it does make me wonder whether they're doing the right thing or not. They're making huge profits still. I don't know where from, you can never really find out. Lloyd's, for example, made massive profits last year of 4.4 billion pounds, probably from mortgages, financial services, all sorts of different areas, probably current accounts, fees, penalties, overdraft charges, whatever. And they've just been slammed, of course, with another, was it 2.5 billion PPI fines. Of course, they would have made a much more of a profit if they hadn't got that. I mean, Lloyd's in total paid 21 billion pounds in PPI. 21 billion pounds they've paid out to people who they've missold to in the past. That's just atrocious, really, isn't it, if you think about it? And they're advertising on telly that, you know, that they're the bank who are with you all the way. You know, it just makes you wonder. But that's the banks, up to them what they do. I think the future is not these lovely branch offices in the centre of town. I think the future is digital. They've got the money to spend on AI and apps and technology. And it's all about the smartphone. It's not going to be called a smartphone in the future. It's your personal digital assistant. That's what it'll be. You'll talk to it. It'll learn from you. It'll coach you. And that's where the banks will come into their own in the next few years. I'm quite sure of it. Branches, I think, are a thing of the past. I really do. You need to move on there, banks. You need to move on. Okay, let's talk about some more important topics for everybody then. A couple of things in the news, of course, recently that have been quite appropriate. We've got investment trusts, which are in the news at the moment. Now, I want to talk a little bit about investment trusts, just to get you back up to date. Obviously, with CMAT, CMAT 1 specifically, we're talking here about your investment products that you need to be aware of. And one of them, of course, is investment trusts. Now, the whole point behind an investment trust, if we just put a few thoughts up here on the board for you, the whole point about an investment trust is it's an investment that you put your money in. So you might have, for example, you know, £100,000 to invest, but you want to invest it for the long term. That's the whole point behind investment trust, for the long term. And you want to invest it for a period of 10 plus years, maybe more. And the point about investment trusts is that it's not an open-ended fund. Investment trusts are closed funds. In other words, the fund managers get your money, but issue you with shares. Now, it's the shares they issue you with, and you put your money in, basically in the fund, but they issue shares. The shares can be marketed or sold on the stock market. So if you're lucky enough to find somebody that wants to buy your share, you can trade that way. You can't flog them back to the holders, the fund managers. That's the whole point behind investment trust. Now, being closed, of course, means they have a long-term view about your investments and what goes on. And that's fine if everything goes well. Now, there's a guy called Neil Woodford. Probably heard about Neil. Bit of a star fund manager, bit of a superstar rock star fund manager. And Neil Woodford had a great pedigree from Invesco, I think. And he set up on his own in 2014. And he started up a number of funds. This one was called the Woodford Equity Income Fund. Equity Income Fund. There you go. Which at its heyday produced a huge amount of attraction and brought in sort of £3 to £4 billion worth of people's money. And at one point, he had something like 300,000 investors who'd put their money into this income fund because he had such a really good name, which is great because you're attracting business, aren't you? And the whole point about Neil is that he had a great track record. He was advertising 5, 6, 7% returns on this one because people own shares; they therefore receive dividends on those shares, and therefore people would love this. They're getting their money, putting it in the long term. Okay, investment trusts are a bit risky, but Neil Woodford's got a great track record. We're getting great income from this fund. So Neil, of course, started investing in some areas that he felt the right places to go. And he made some mistakes. He made some investment mistakes. He put a lot of his money in illiquid funds or liquid companies that couldn't be sold very quickly because the investment trust invests in shares of its own. That's the whole point behind it. And it all started to go a bit wrong last year. And people started to get a bit nervous and they wanted their money back. So they tried to sell shares and get their money back. But of course, they couldn't do that because they couldn't liquidize the shares quick enough to pay back the money. And so in a nutshell, what happened is they suspended the fund. They suspended it back in 2019. They stopped investments. They stopped, obviously, shares being traded and withdrawn. We had some OICs as well. They stopped the people taking their money out, and that of course causes problems. People then start to get very nervous. Neil carried on, maintaining the fund. And it was only this week, I think it was last week actually, that it was announced that, or the administrators announced that people are going to get 46 pence back. 46p to get the numbers right for you, to 57 pence per £100 per pound, if you like. That's what they're getting back. The initial tranche. So people can lose a lot of money. People are losing their money. They're losing their lump sums, which is quite scary, which proves the point that it's risk attitude that really matters when it comes to investing. Investment trusts are high risk because of the nature of being closed and the investors can invest where they want, which is some pretty scary stuff, really. People will lose money. It's the capacity for loss that you need to find out when you're advising customers on investing money. Are they willing to lose their money? You ask that question, get people to really think about it. So that's investment trust, really. Just a bit of an update for you on what's going on there. So Neil Woodford is no longer the star investment manager. I think he's got a fair bit of money, though, to look after himself. He's probably done all right. Probably got most of it in his pensions. Still get high rate relief on pensions. That's probably what he's done along the way. Bit naughty, that one, but there you go. Let's have a look at a couple more changes that are coming in. Now, the next topic I want to talk to you about is Help to Buy, changes to the Help to Buy situation. Now, Help to Buy is a government initiative, of course, brought in 2013, I think it was, by George Osborne, to boost the housing market. And it's worked. It's very, very clever. People criticise George Osborne, but he actually had quite a few decent strategies, actually. Very clever guy, particularly with the landlord market. His strategies do come off. Back in 2013, what he was looking to do is he was looking to get builders to build lots of new homes and for lots of people to buy these new homes in a very stagnant market. So he offered to Help to Buy. Help to Buy is a very clever little system. What happens here is up to 20% of the value of the property that you're buying can be taken out as a government equity loan. Here we go, equity loan. So you don't need, therefore, to find 20% of the value of the property. You need a 5% minimum deposit of your own money, of course you do. But you can also then get a mortgage, say, 75% loan to value mortgage, LTV there. And that's great if you want that as well, because lenders can flock to you for that because it's all good lending for them. And it worked, it worked. And the numbers speak for themselves. 360,000 households took out a Help to Buy government equity loan. Approaching, I mean, the numbers from 2021 onwards, it's sort of £22 billion of taxpayers' money has been used on this. Obviously, not taxpayers' money; they've just borrowed on the equity market, on the gilt market, the government to fund this. But the clever thing is, the government are going to make money from this because this government equity loan that you take out, this is a loan, yeah, of course it is, but you don't pay any interest on this for 5 years. So, you know, happy times, because you don't. You pay mortgage payments on your mortgage, of course, but you're basically able to get yourself a bigger property. So rather than buying the 2-bedroom house, you can afford the 3-bedroom house, or you can buy in a better part of the estate, because it's new homes only that this has been marketed towards. And that's a great thing. But the problem was, it wasn't just first-time buyers. Anybody can do this. Second, third-time buyers can use this as well. So people have been buying the huge properties financed by the government. I don't really think that was what it was intended to do, but it's worked. So they're going to make some changes. They're going to make some changes, and quite simply, the changes are that from 2021 onwards, it's first-time buyers only. First-time buyers only can have this, and that's fine. They also put some caps on the maximum amount of money according to the region that you're in. So you need to look at a table. It's got different regions, London, South East, whatever, and different maximums, and that's fine. That's right thing to do. That's pretty much the changes. They reckon 81% of people anyway are first-time buyers, so not a huge amount of difference. But the big one, of course, is that from 2023, there you go, these are being withdrawn. So no new applications for Help to Buy, and that's fine. Let's put a little title up here so we know what we're talking about. So let's just have a quick look at some of the implications of this for mortgage advisors, mortgage brokers. If you're in the business of advising customers, you've probably got people with this type of mortgage. You've probably got clients who've already got it. So you need to think about this carefully, because the sting's in the detail. Now, people don't have to pay interest, we know that, but after 5 years they do. And after 5 years, the interest starts to rack up a bit. At the moment, they're going to charge 1.75%. It's kind of, you know, stepped in. You need to check the detail of that one. Plus the RPI, plus 1%. So doing your maths, it's quite high, depending on obviously what RPI is. And this interest payment is then made on the equity loan itself until you get rid of it. It's interest only, so the monthly payments are not like huge. It's not like capital repayments you have to make, but you do have to start paying interest. And you have to pay it back at some point. You can pay it off anytime you want to. There's no redemption penalties, but you have to pay it back. But the point is, the government will, when you redeem this mortgage, they're going to look at the percentage of the current value. That's the thing. You know, it might be 20% value that you took it out for, of the value, you know, years ago. But when you redeem it, it's the current value that the government are going to slap, say, for example, 20%. And if your property prices rocketed, which they are in certain places, that's going to be a large amount of money got to pay back. So a lot of people are looking into this now, what they can do. There's a lot of lenders operating Help to Buy remortgage mortgages. There's a couple of things you could do. Your customer could certainly remortgage the whole shebang, couldn't they? If they didn't want to sell the house, they've got this 75% loan to value mortgage they took out when they bought it, but obviously the house price has gone up, hopefully. So and their salaries have gone up, so they remortgage the whole thing, and the lender probably will only end up lending 75% loan to value, but a higher amount to get rid of the government loan, pay it off after the 5-year period, and then pay your mortgage, your bigger mortgage, on a lower rate of interest. So there's certainly scope for that. And if you can get a lender that's going to pay the fees for you, the legal fees, because when you remortgage, you've got to have legal fees paid as well. So that's something to think about seriously. The other one to consider is a second charge. Not a lot of people would consider this, but I've got lots of clients now that get involved in second charges. And second charges are not as expensive as they used to be. You used to have a bit of a bad rap for high charges and high fees. Not now. So if your customer, for example, doesn't want to pay off their existing mortgage, maybe they've got fixed rate redemption penalties on it or something like that, which is great, then you just take out a second mortgage. So you take out a second charge to repay the government equity loan. And the second charge itself might be sort of 2 or 3% interest. So a lot lower than the government are going to charge. But you've obviously got to pay lump sums of it. You've got to pay capital off of that as well. It's not an interest-only one. So that's another option. So first charge the whole thing with a remortgage with another lender, or maybe the same lender you're with. Maybe even a further advance might be an option as well. But there's definitely options here for brokers. Don't forget the life cover as well. A good broker should have effective life cover on the government equity loan as well as the mortgage. Hopefully they did that. If they didn't, make sure you got full life cover and health protection as well on that property. But a good system. It's worked really well, Help to Buy. It's helped a lot of people. It's also helped, if I may be so bold to say it, the CEOs of these house building companies who've reaped a lot of profits from this. Was it Jeff Fairburn or was it Jeffson from one of the house building companies? Made a fortune, made off with a salary of about 80 million or something because of the Help to Buy. This has helped them just increase their share price. But there we are. That's a bit political, isn't it? We won't go there on that one. So yeah, useful update for you. That has been useful. Okay, let's Help to Buy then. So let's move on to our final topic of our live stream today. Hope everybody's well, by the way. We've got a few more people joining us on YouTube, which is great to see you. Those of you on Bootcamp, of course, get to see this on HD, so full HD version. Those of you on the podcast only get to hear. That's fine, you might be driving, so you can't watch at the same time. So let's take a look at my last topic for you, which is the Scots Law. Now, I'm off up to Scotland this afternoon, catching the train up to Perth. Long old drive, a long old run, I should say, but I can do my work on my laptop. Looking forward to going up the hill. It's a bit snowy up there, I believe, so let's hope the trains aren't cancelled. Doing some work for a client up there, doing some training on equity release, which is fun for a bunch of people up in Perth. Now, as you know, for those of you studying CMAP 2 and CMAP 3, you've got this thing called Scots Law. And for those of you doing the CF6 exam, which is the CII's version, a lot of people who are doing that exam also listening to this podcast, you do need to have an understanding of Scots law. Now, if you've opted for the Scots law paper, you're going to have a deep understanding of it. If you've opted for the English and Welsh law paper, then you don't. But you need to have an understanding. And the clever thing about Scots law is that arguably it's probably a better system. So what I'm talking about is the Scots Home Report. I want to tell you about how this works because not a lot of people south of the border understand this one. Now, in Scotland, the house purchase process is different. It's very different. And if I put a little sort of time scale along here for you, here's your timeline. In England and Wales, just put that down here for you. In England and Wales, just to sort of refer to them, what happens here is somebody starts viewing properties. They then make an offer when they found a property. The offer is accepted subject to contract. You're then going to apply for your mortgage. You're then going to do your survey. You're then going to do all your legals. And then eventually you're going to exchange contracts, which as we know, of course, is when you can't then change your mind. If you're doing it with a lot of money. So that's the process in England and Wales. It takes a long old time. When we bought our property last year, the year before actually, we started buying it. We viewed it in November. We didn't exchange until February, just before Christmas is in the way, and they all close for 2-3 weeks, don't they? Because it takes time, and people drop out. So that's the issue. And people spend money on these things, and then right until the moment somebody pulls out, and they lose all this cash. Now in Scotland, they do it differently. In Scotland, they do it differently. What they do here in Scotland is effectively you make an offer. But once you've looked at properties, a lot of work's been done. So you're viewing property, so you do it the same way. Now, when you see a property that you quite like, the purchaser in Scotland needs to create some information for you to have a look at. And what the vendor, I should say, what the seller of the property does, is they do a lot of work. So let's put the property that's been looked at for you. There's your property. And you've got the seller of the property. There you go. He or she is selling that property. So they got it up for sale. There you go. What the vendor has to do, we call them the vendor, don't we? Bit of French, I think. What the vendor then does produces or spends some money on some information to help you. So what they do is they get a pack together. They look at the legals, so that they get a little bit of legal information together. So they have a solicitor and they get say draft contracts. Some of the searches are done. Some of the basic information is created to help you to exchange contracts. But they also produce a home report. Now the home report is commissioned by the vendor, paid for by the vendor, and the home report itself is a bit like a survey, so it's a survey of the property. It also has an energy report attached to it as well. There's also some information about the condition of the property. It's not a full structural or full building survey, but it's a pretty darn good survey of the property, commissioned for the vendor. Obviously, there's some legals. There's a property questionnaire as well, which they create. So if anyone remembers the home information pack we talked about in England and Wales back in the early noughties, never really got off the ground. The energy report did, but the home information pack never really got off the ground. In Scotland, they still do. And the vendor produces this. Now, it then changes everything, you see, because in Scotland, what happens is that the person starts viewing. Because they're viewing, they're also getting access to this pack. So the person viewing can have a look at the legals, the home report themselves, the property questionnaire. They should, of course, get their mortgage agreed in principle. So a decision in principle is then affected by the purchaser. But what they then do is they find the property. They then make an offer on the property. And if the offer is accepted, you basically go all the way from here, all the way to there. So in Scotland, when you make an offer on the property and it's accepted, they call that the missives have been concluded. There you go, missives concluded. Because you make an offer, it's accepted, missives concluded, you've exchanged contracts effectively in Scotland, and that's the big difference. And as you can appreciate, therefore, there's none of this lengthy time of lots of people going through the situation. I think it's a really good system. Okay. Drawbacks though is that the vendor has to pay some money, but why not? They're selling the property, so they ought to do that really. The purchaser, they've got to get their mortgage agreed in principle, but you should do anyway. And if you're happy to rely upon the legal work that's been done and the home report, you make your offer and it's accepted. It's designed, you see, to stop everybody who's looking to view and purchase or make an offer all doing the same thing all at the same time. It's designed to save those costs. So I think it's a really clever little system they've got up there, which I think works really well. Obviously, once the purchaser's made the offer accepted, they themselves can do their own survey if they want to, and any mortgage lender can get a mortgage valuation done. Usually the same surveyor that's done the home report could certainly do the mortgage valuation at a vastly reduced price, maybe, or whatever the cost of negotiating. So there's a little detail there going on as well. So that kind of summarises really how it all works in Scotland. I think that's a good system. You're cutting out all of the long-winded applications and chances for people to pull out. It does cause more costs for the vendor, fair play. You've got a number of people obviously viewing, looking at all the same information. But once offers are all made, they're all looked at, accepted. You can have offers subject to survey sometimes if you want to, or subject to more legal work being done. So offers can be subject to something up there, of course. But if it's an unconditional offer, then it's accepted or not, and then missives are concluded. And that's the way the Scots law system works. Which is why in Scotland, estate agents tend to be the legal people as well. Lawyers, solicitors tend to be the estate agents as well. Because it's all tied in together, you see, at the end of the day. Quite a neat little system. Just a little update for you on Scots law. There you go. So, kind of wraps up our live stream today, I think. The weather out there is still atrocious as it was when we started. It's a bit better where you are. We just seem to have tons and tons of stormy rain here. I can't wait for a bit of sunshine to come up and enjoy a bit of vitamin D, I think. Anyway, I'm off at Scotland this afternoon, so we'll catch you all next week and have a great week. Bye.